Okay, it's Wednesday night, 10:30 on October 12th, and I want to talk about a little bit about the bearish side today. Um, so let's make the argument that the market's going down because there's been some things in the last few days that I think are important. Uh, Starting first, as I always do, with is the market crowded, right? So here's the Dow chart. Here's the positioning. So look, up here, we were super crowded. This is where speculators are super crowded, right? And this was the market here, right? So arguably at the top, it was super crowded. It's come off a little bit, but that's what they do. They work their way off from super crowded to, when they get out of it. They've got out of some, when that big fall happened a few weeks ago, but there's more to go here, right? So there could be more to go. So is there crowdedness that can be worked out still? Yes. And this super crowded stuff started, late August, really, early August almost, really around here is where the super crowdedness started, and it kind of just held this whole time. And just as an example, here's gold, right? So gold was super crowded starting here early July. There's the top. It really didn't go anywhere. I mean, here's August, here's September. It even zipped back here, in early September. But, working off that crowdedness, it has done, right? I would argue people were a lot more bullish gold this whole time than they are stocks. But again, from a data point of view, from a crowdedness point of view, super crowded at the top. Sometimes it takes a long time for this stuff to work out for whatever reason. Sometimes it goes quick. Gold, here's an example where it took a long time, and bang, bang, bang. People are like, why was gold down so much here? Well, they've been mega long. It broke these sucking technical levels here, kind of thing, and down it goes because they all get stopped out. And just from a technical level, look, the Dow's breaking through 18,000 here. That's sort of this technical level, right? And they're still crowded, so there's some danger there, no question about it. S&P, which I've talked about before, really does not show any sign of crowdedness. Nasdaq certainly does. I mean, this is the most crowded Nasdaq they've been, which it should be because it just hit all-time highs 3 days ago, right? But again, we've got support here, starts breaking through some of these support numbers with mega crowdedness. You have trouble. And the Russell, too, same thing, right? Doesn't look it here, but this is the longest speculators have been in quite a while. Here's where they were the longest, and again, that was this top here, right? Sold off, they got out of a lot of it, went back up, they're kind of back in. So, and again, technical levels come in, same story. So is there a risk from a crowdedness point of view that the market can go down? Absolutely, right? Fundamentally, I mean, do I really need to get into the fundamental argument of why you need to be bearish stocks? There's a billion reasons. Pick one. I don't even get into that, right? We all know all the fundamental reasons why the market can go down. But from my point of view, from a tape reading point of view, right? For me, what I've heard, what I've been told for the last however many months, what I've read, is essentially, the risk was that the Fed was going to raise interest rates and that was going to cause the market to go down. I always thought that was ridiculous. A quarter, point hike doesn't mean crap. And then we heard the election. We've been hearing Donald Trump is bad, because he's crazy, and Hillary Clinton's good because it's more of the same. Well, let's think about what's happened in the last week or so on those terms, on the election terms. I mean, Trump's done. It's essentially a done deal, right? Hillary's going to be the president, so that was supposed to be good. From the economic and rate raising point of view, I mean, we had the big day to me was we had the employment report come out on Friday, which was this day, right here, and the employment report was, not hugely. It wasn't a huge number. It was a pretty benign number. It was a neutral number. We haven't heard anything from the Fed that said that means they're definitely going to raise rates or anything. And the market closed weak that day. And that's the first time, I mean, up until now, it was like the market always ripped unless there was some kind of huge number that was going to cause interest rates to go up. Here we had an employment number that everybody was watching because we got this November meeting and the December meeting and all that. It was pretty benign. The Fed speak was pretty benign. And the market went down then. And it's still going down since then, right? That's bad tape, okay? It's a market that is going down on the news that the bulls wanted to hear in a market that has showed crowded long, right? That's bad. It's bad. So from a crowdedness and a tape reading point of view, which to me are the most important things, the reaction to the news is more important than the news to me. especially when the market's crowded. You know, it could go down here. Plus, you're going to break these technical levels possibly. Boom, right? I still don't think the market's going to crash. And look, I'll be short anyway. I don't really care. But to me, the sentiment is still too bad. People want to get short. They break these technical levels, they will get short. The market will go down. And I still think that's going to offer a buying opportunity somewhere in there. But again, that's all bullcrap. For right now, let's focus on the fact that these levels where the market traded, the highs of the day, on employment day, to me, are a great place to be short again. So unfortunately, you're looking at about 200 to 300 points away from where it is right now on the Dow. But, you know, you risk 200 points, you can make, I mean, shit, man, we go down test here, whatever, you know what I mean? You make 1,000 points, you're looking at least a 3-to-1, you know, 3-to-1 risk reward here. So I think that's the trade here. I think the trade is short against the employment day highs until, you know, until this crowdness gets out of the way, or until the tape acts a little bit better. And I'm not going to make a video every time that happens, but, you know, I think that the trade is short here. And then we can, you know, reconfigure when it looks like everybody has sold out and now everybody's bearish again, and, you know, the tape starts to act better, we can long it, but, you know, we can talk about that then. And again, the only fundamental comment I'll make is, because I have to be against everybody else, what they're thinking. They've been thinking, you know, too much strength, there's going to be higher interest rates, and that's bearish. To me, and I spoke about this last December on one of my videos, that's not the risk. The risk here is no strength, right? If there's a weakness in the economy and the Fed doesn't have to raise, what are they going to do? They got nowhere to lower. And this is sort of something people have talked about, but hasn't really been the focus for the last few months. The focus has been this whole thing, too much strength, too high interest rates, blah, blah. But to me, too much weakness, no room to lower interest rates, you're fucked. And that's sort of what the tape is doing now, right? So careful on the long side at the very least. All right, good luck.